works. So let's get started. So the Ichimoku Cloud indicator, it's a technical indicator. So there are fundamental analysis, there's technical analysis. That's beginner level stuff that you can probably look up on Investopedia if you're not sure about. But it's a technical analysis side. It's a technical indicator. It's an indicator that you can plot onto your chart and use with your candlesticks to figure out what the trend of the stock is going to be going to, if it's bullish, bearish. It's it's a effective dynamic trend following indicator. It was developed for over 30 years before being released to the public in 1969. Its Japanese name is Ichimoku Kinko Hyo, which roughly translates to at a glance equilibrium chart, but we just call it the Ichimoku Cloud here in the West. It was created by Guichi Hoshida. He was a well-known Japanese journalist back then. He tracked the rice futures market, and he wrote 7 books on his trading methodology, his philosophy for trading, and about how this technical indicator works. And those books were bestsellers for nearly a decade. So it was really, really popular in Japan. And it kind of dropped out of use a little bit after a decade, but it had a resurgence of use back in the 90s, and now it's still popular in Japan. So a lot of funds in Japan actually use the Ichimoku Cloud indicator as a basis for their trading algorithm. So it's a pretty time-tested, effective trading indicator. So at a glance, the indicator probably looks like a giant mess because you've got a bunch of different lines on the chart. It's actually really easy to use once you learn how each of these 5 lines work with each other. So they work together. They also give you guidelines for entries and exits, so you can use it to figure out when to buy, when to get into a trade, when to get out of the trade. So it's really effective that way. So it's like a whole trading system. It works together to help you figure out how you should be approaching a particular stock you're looking at. So we've got 5 different lines. The first line we've got here is the Tekken conversion line, which is going to be this blue line here on the chart. We'll go over that in detail in a little bit. Then we've got the Chu Bas Line. It's going to be this purple line here. And then we've got the Chu Span Lag Line, which is going to be the red line. So Tekken is going to be the Japanese name, obviously. Conversion line is going to be the English name. Kujinsen is Japanese. Baseline is going to be the English name. Chiku Span is the Japanese name, and lagging line is going to be the English name. So Senku Span A is the Japanese name as well. Span A for the top line over here of this cloud. And then we've got the Senku Span B, which is the Span B line, we call that in English. So it's going to be the yellow line here for Span A and the white line here for Span B. And then we've got this color fill-in of the cloud, which is going to be called the Kuma, or the cloud itself. We'll get into detail on that in a little bit as well. So let's go over the Tekken conversion line first. The Tekken conversion line, the blue line on the chart, is a moving average line that's created by adding the highest and lowest prices of the stock over the last 9 candles. So you're taking the highest price of the candle and the lowest price of that candle, not by the candle body, but by the candle wicks. So the highest price that candle has even gotten to and the lowest price that candle has gotten to. So you're adding those together over the last 9 candles in the chart, adding that together, then dividing that sum by 2, and then plotting that onto the chart. So it's a midpoint calculation. So the difference between a midpoint calculation and a more common calculation we have in moving averages in the West is like simple moving averages, for example. To get the calculation for a simple moving average, which is very commonly used, what we do is we take the closing price of each of the candles for however long that moving average is. So if it's a 9 candle simple moving average, we'll be taking the closing price of the last 9 candles, adding that together, and then dividing by 2. But the difference here is that the Tekken conversion line is using a midpoint calculation. So we're taking more data points and we're accounting for the price action in each of those candles by taking the highest and lowest prices, adding them together, dividing by 2 to give us a more balanced look with more information on how this stock has basically moved in accordance with the moving average line. So the conversion line, it's a line that's helping you gauge the immediate to short-term support and resistance on the chart. It's only taking 9 candles of data, so it's going to be sticking closer to the candlesticks on the chart. It's going to be more volatile, and it's basically going to be the closest line to the candlesticks you see with the Ichimoku Cloud indicator at all times. So if the share price on your chart is above the Tekken conversion line, then this line will function as a support level. If the share price is below the Tekken conversion line, then this line will act as a resistance level. So let's see here, while share price is above the conversion line, the line will function as support level. So you've got these shares currently above this blue conversion line. That means this blue conversion line will act as a significant level of short-term support for that stock. You'll see this area right here, the share price did break beneath the conversion line, so that's significant. It broke the short-term support, but the very next candle here, it did break right back above that short-term support for the conversion line. So over here's an example of the share price breaking beneath the conversion line. So when the share price breaks beneath the conversion line, this conversion line turns into a resistance line. So instead of support, it's now resistance. So the share price has to break above that conversion line for that conversion line to flip over to become support again. So in this area here, not including this red candle here that's broken beneath the conversion line, but basically all of these candles here that you see on the chart are all above that blue conversion line, showing that this conversion line is acting as support for that share price at that moment. And it's being actually effectively used because there's only one occurrence during that whole time frame where the share price managed to break beneath that conversion line, the Tekken conversion line. And down here, you can see multiple examples of the share price being beneath the conversion line, acting as resistance. So you've got a big red candle here that managed to break beneath the conversion line up here. And all these candlesticks here and all these candlesticks over here are all beneath that short-term resistance. So this conversion line is acting as resistance for them during that time period. So when you have this green candle here break above that blue line again, this blue line becomes support again. So during this time frame where the candlesticks are above that blue line, the blue line, conversion line, is acting as support. So that's Tekken conversion line. So the next line we're to go over is going to be the Kijun baseline. So the Kijun baseline is going to be the purple line in your chart. It's going to be that line right here. So the difference between the Kijun baseline and the Tekken's conversion line is that the Kijun baseline, it's also moving average, and it also uses the similar midpoint calculation. So what it does here is that the midpoint calculation for the Kijun baseline is using the last 26 candles in the chart. So it's taking the last 26 candles on your chart, taking the highest and lowest prices of each of those 26 candles, adding them together, and then dividing by 2 before plotting it onto the chart. So it's taken more data points than the Tekken's conversion line, and because it's using a wider set of data, it's not as volatile as the conversion line. So it's going to be a smoother line, and it's going to be further away from your share price because it's got more data points. So the Kijun baseline is going to be used as a short-term to mid-term support and resistance line. So you would put more weight on this line, more importance on this line when comparing this one to the conversion line, because if the share price does break beneath the Kijun baseline, that means that the share price is likely to be more significantly bearish than when it breaks beneath the conversion line for a little bit and goes back up, for example. So the Kijun baseline up here, all of these shares here, all the candlesticks here from this time period is above this purple baseline. So this baseline is acting as significant support throughout that whole time frame. So you'll see that the share price here did break beneath the Tekken conversion line, but it didn't touch the baseline. It got close, but it bounced off and went right back above that conversion line to continue its run up, continue its bull run. So here are clear examples of the distance between both of these two lines. So the Kijun baseline is going to be further away from your Tekken conversion line because it does use more data points. So it's going to be a smoother line. It's going to be further away from your share price. It's going to be close to the share price, but it's not going to be as close as the Tekken conversion line. Not going to be as volatile either. So down here is another example. During this whole time frame, all of these shares, except for this gap right there where the share prices did break above that break above that baseline for a little bit, it was acting as resistance. So the Kijun baseline for this whole time frame here was acting as resistance before it finally broke out here with that big gap up green candle. So we're going to be getting into detail with the Tekken conversion line and the Kijun baseline and how they work together in a little bit, but we're going to go over the other lines first. So the next line on the Ichimoku Cloud indicator we're going to be going over is going to be, well, next two lines. Technically, 2 lines and a significant part of the Ichimoku Cloud indicator is going to be the Senku Span A and Senku Span B line. So the Senku Span A line is going to be this yellow line here, this top line. And the Senku Span B line, is going to be this white line here. So both the Span A and Span B lines work together to form the Kumo portion of the cloud. So Kumo is cloud in Japanese. We'll just call it cloud in English. So the cloud is going to be this colored fill-in area of the Ichimoku Cloud indicator. So it's going to be green color fill-in and a red color fill-in. And these areas are going to be the cloud of the Ichimoku Cloud indicator. Now, the color of the cloud is a quick identifier that you can use to figure out if the stock is likely going to be bullish during that time frame or bearish during that time frame. So, for example, here with the cloud being so green, that means that the indicator is expecting during that time frame when the share price gets to it that the stock is going to be bullish. And when it's red, like here, that means it's expecting the share price to be bearish during that time frame. But just because the cloud is green and just because the cloud is red doesn't mean it's going to be bullish or bearish all the time. It's just a little quick identifier that you can sometimes use. So both the Span A, Span B lines used to identify significant levels of areas of support and resistance for the chart. So if the Span A line is above the Span B line, the cloud portion will be green. If the Span A line is below the Span B line, it's going to be red. So Span A line is going to be up here when the cloud is green. The Span B line is going to be down here when the cloud is green. But they flip-flop when it's red. So the Span A line is on the bottom when the cloud is red, and the Span B line is going to be at the top when it's red. Now, the significance of which line is on top and which line is on the bottom doesn't really matter. Both of these lines are going to be still used and seen as significant levels of support and resistance for that stock. So the color of itself is basically a quick indicator of if it's bullish or bearish. Now, the more significant indication of if the stock is bearish or bullish is where the share price is in relation to the cloud itself. So if you have share prices up here above the cloud and the cloud is beneath all those shares, that means that the overall trend of the stock is going to be bullish because the share price is still going up and the cloud is moving up dynamically with it. And if the share price is beneath the cloud, like over here, that means the overall trend of the stock is likely to be bearish, and it is bearish during that time frame. Now, the formation of the Span A line and the Span B line are pretty simple. The Span A line is basically a combination of the Tekken conversion line and the Kinm Bas Line's calculations. Add them together and then divide them by 2, and then you plot this line 26 periods into the future of the chart. And then you take the Span B line, which is also a midpoint calculation. For the Span B line, you take the last 52 candles in the chart, add the highest and lowest price of each of those candles, and then divide them by 2. And then you plot that line onto the chart and push it 26 periods into the future. So you can see that the cloud is actually further ahead the current share price. And we'll get into why it's pushed 26 periods into the future as well in a little bit. So the thickness of the cloud is also important. So in a thick cloud, that means that the support and resistance levels are spread out between both the Span A and Span B lines. So that means when the share price gets close to either the top line or the bottom line of the cloud, it's going to have a very easy time breaking through either the top line or the bottom line if the share price is beneath the cloud. But it's going to have a hard time breaking through the cloud completely because of how thick the cloud is and how spread out that support is or how spread out that resistance is. In a thin cloud, you don't really have a whole lot of that support and resistance spread throughout the cloud. You have those support and resistance focused on the Span A and Span B lines. So in a thin cloud, the share price is going to have a much harder time breaking through either the Span A or the Span B line. But if it manages to break through either of those lines, that means there is a very good chance that it'll be able to break through the cloud altogether. And if the share price breaks through the cloud, like right here, for example, the share price is below the cloud, it breaks above the cloud, that means that the overall trend of the stock is likely to be bullish now because it's broken above the cloud. And if it's broken beneath the cloud, like here, that means that the overall trend of the stock is likely to be bearish. So if you have a very, very thin cloud and the share price manages to break through either of those lines, then it's very likely that the trend shift is going to be quick and it's going to shift over to the downside if it breaks beneath the cloud. It's same vice versa if it's breaking through the cloud to the upside. So if the share price is inside the cloud, that means that the stock is in the consolidation phase. So that means the share price is still figuring out if it wants to go up or if it wants to go down. The trend isn't completely defined for the stock if the share price is inside the cloud. So during the period of time where the share price is inside the cloud, like here and here, that means the stock is in the consolidation phase. So there's no particular action that you should be taking, but you could trade in a consolidation phase depending on other factors. And we'll get into that in a little bit as well. So the Chu Span Lagging Line, which is going to be the last line we're going to be going over. This line is very, very simple. It's very easy to make. So what you do is you take the closing price of each of those candles on the chart, and then you plot onto the chart, and then you push this line 26 periods back into the past. So it might sound kind of useless. Why are you taking the closing price of each of these candlesticks and then plotting onto the chart as a line and then pushing it 26 periods in the past? But it's actually pretty simple. So the reason they do this is because this lagging line, this red line here, Chu Span Lagging Line, it's going to be used as a gauge of momentum. So it's a shadow of the current price action compared to the price action that the stock had 26 periods into the past. So if the lagging line, the end point of the lagging line where it ends right there, is above the previous price action, which is down here, candlesticks down here, that means the current price action, the present price action right here, is more bullish in momentum than the previous price action back here. That indicates that bullish momentum is still in the stock and there is potential to keep going up. So you can still ride this stock up because there's no indication that it's stopping right now. Now, this Chu Span Lagging Line works in conjunction with something we call the TK crossovers that we'll get into detail in a little bit, and that'll help you find entries and exits in the Ichimoku Cloud indicator. So when the endpoint of the lagging line here, let's say right there, share price is all the way up there, and the lagging line was ending right here at the time, that means that this candle right here, the overall momentum of the stock was still going down. So lagging line beneath previous price action here means current momentum at present price is still going down. So it's an indication that, okay, you can still ride that stock down if you're shorting the stock or if you're buying puts. So you can tell the trend of the stock at a glance by identifying the share price in relation to various lines on the chart. So it's really easy. So you can tell at a glance that the current bullish momentum of the stock is stronger than it was in the past by looking at the lagging line here. Lagging line is above previous candlestick here, 26 periods back, compared to present price action. So the momentum of the stock is still bullish and it's still going up, so it's good. The overall trend of the stock is bullish because share price is already above the cloud after a break above the cloud here and is still above the cloud at present here. And the pushed cloud portion, that's 26 periods into the future, is going to be where the cloud is predicting significant levels of support and resistance are going to be in the future. Now, the fun part, the TK crossovers. We've got trade entries, exits, decision making. So TK crossovers occur when you have a Tekken conversion line cross above or below the Kinm Bas Line. So TK crossovers are the primary confirmation signal for when trend shifts have occurred. So instead of trying to predict when the bottom of the stock, where the bottom of the stock is, where the top of the stock is, the TK crossovers are designed to give you confirmations that the trend has actually shifted to the upside or the downside. So how we use this is when you have a conversion line, the conversion line, which is going to be this blue line here, when you have the blue line, conversion line, cross above the baseline, which is the purple line, that means we have a TK cross up. Now, there are a couple of other factors you need to look at as well. So when you have a TK cross up occur, you want the share price present to already be above this blue conversion line. If the share price is above the blue conversion line, that means that this TK crossover to the upside is likely to be still bullish, to still play out. You also want to look back at the end point where the lagging line ended during that TK crossover when it happened. So the lagging line would have ended right there in line with share price, which is right here, when this TK crossover to the upside happened. And this endpoint for the lagging line is above previous candlestick price action, which indicates that current momentum, current price action is more bullish than previous price action 26 periods back. So that's why you would buy here on the TK cross, you would buy on that candlestick, and then you would ride that share price up. So the Tekken conversion line and the Kijun baseline can both act as profit-taking points and stop losses, and because they are dynamic, they move with your share price, which helps a lot. So you don't lose money basically, and you can take profit at very confirmed levels where the momentum is slowing down, or the momentum is breaking down, breaking beneath support levels or resistance levels if you're shorting the stock. So we've got traditional guidelines. You've got TK crossovers that happen, TK crossovers up that happen that are above the cloud, which there are none on this chart. But if you have this TK crossover to the upside happening above the cloud, that means the signal is strong. If you have TK crossover to the upside below the cloud, that means the crossover is weak. But if you have a TK crossover to the upside inside of the cloud, like for here, for example, that means the signal is neutral. So the strength is going to be neutral. We have TK crossovers to the downside, which we'll have another example of that in a little bit. But TK crossovers to the downside are like this area, for example, where you have the conversion line crossing beneath the baseline. When you have crossovers to the downside happening above the cloud, if it's like up here instead, that means it's going to be a weak signal. If you have a TK crossover to the downside inside the cloud, that's going to be a neutral signal. If a TK crossover to the downside beneath the cloud, that means it's going to be a strong signal. Now, those are traditional guidelines for how to use the Ichimoku Cloud indicator with the TK crossovers when the indicator was created and released to the public. But in modern use cases, it's not that important anymore. So even though you have a clear TK crossover to the upside beneath the cloud happening here, you can still easily play that and play that to the upside and take that trade from beneath the cloud all the way to the top of the cloud. So that's basically how the TK crossover to the upside works. So you got a TK crossover to the upside, lagging line is above previous price action, which is good. Share price is above conversion line, so you make an entry here. You hold the stock. Candlestick did break beneath that conversion line there on that red candle, so you would take profit there. But the very next day, the candlestick did break and close above that conversion line again, Tekken conversion line. So you can make another entry, a re-entry, ride that stock all the way up until it broke beneath the conversion line here again, take profit. And then when it broke above that conversion line again, you can go ahead and make another re-entry. Depending on, it's up to you how much you want to re-enter. Re-enter that stock, ride it up, and then you have another red candle that broke beneath the conversion line. So you would take profit again, and then the very next day it broke above again. So you would re-enter. Now you're riding it up even further. So there's no break of the conversion line here. It did break during the day on this red candle, but it didn't close. It didn't close beneath it, so it's fine. So you hold it, and now you're still in the trade because it's still a bullish move. So the stock is still running. It hasn't broken beneath the conversion line or the baseline yet. And if you don't want to get in and get out so many times when it breaks the conversion line, you can just use the purple baseline here, the Kijun baseline here, this purple line, as your stop loss profit taking point. Now that's only if you have a higher risk tolerance, because the conversion line will protect you with a lower risk tolerance. So you can guarantee you actually take profit with the conversion line. The baseline, there are some cases where you will be taking a loss if it goes the opposite direction from where you expected the stock to go. But in most cases, if it's like a bull run like this and the share price from up here suddenly breaks beneath this purple line, you're still taking profit because your initial entry point was all the way down here and you're taking profit all the way up here. So this is how the TK crossover to the upside works. So the next example we have is a TK crossover to the downside. So for this, you've got a TK crossover to the downside happen right here. So you would make a short entry position, or you would make a put here. You would ride that share price all the way down, and when this green candle finally breaks above that blue conversion line, you can go ahead and exit your position, take profit. And the share price went up even further afterwards and broke above that baseline here, which would be your high risk tolerance stop loss or profit taking zone. So you would take profit there as your high risk tolerance, but it did manage to break beneath again here. So you could consider re-entering here when it broke beneath that conversion line again, just to be safe, because conversion line is further away from the baseline. So when your share price broke beneath that baseline again, you can go ahead and re-enter, take a short position. So short it all the way down until the share price came back up and broke above that conversion line. So when it broke above that conversion line, you can take your profit on your short position of that re-entry that you took over here. And then when it broke above that baseline, the very next candle, you can take profit if you have a higher risk tolerance. So that would be your exit right there. And to reiterate, when the TK crossover to the downside happened, your share price was already beneath the blue conversion line, which is good. That's a signal you want to see. And the lagging line was actually beneath the last 26 period price action in the past, showing that the current bearish momentum here is actually stronger than the bearish momentum in the past. So if you just take this red candle, move it all the way right here, that's where the endpoint of the lagging line would be, and the share price is above it. So this is a good signal. So you would get into that trade. But that's essentially how the Ichimoku Cloud indicator works. It's a very fine-tuned indicator set. It was developed on for over 30 years before being released to public. And back then, they didn't have calculators or computers. So they straight up hired, well, I say hired, but interns aren't hired. They had a whole room of intern students that did calculations on paper to figure out what the optimal settings for this particular indicator would be to help figure out how to chart for dynamic trends, when to make entries and exits with Ichimoku Cloud indicator. So this is how it works. It's effective. It's my bread and butter. I've been using it for nearly a decade of full-time trading, and I hope it helps you guys too. Now, there are a couple of nuances that you should know. The Ichimoku Cloud, it's effective for use over all different types of time frames. So if you're trading on a daily time frame, you're trading on a 1 minute, 5 minute time frame, if you want to trade on weeklies or hourlies, it will work across all time frames. If you're scalp trading minute by minute on 1 minute time frames, that works as well. It's a lagging indicator, so it doesn't try to predict where it thinks the trend will shift. Instead, it will tell you that the trend has confirmed and has shifted to the upside or has shifted to the downside. So you won't be making a whole bunch of predictive trades. It will tell you that you should get in now because it's going up, or you should get in now because it's going down if you want to short the stock. It's also initially designed to work on a daily time frame, but it's so effective that it works across different time frames. You can scalp with it. It's also designed for stocks that are trending. So if you're looking at a stock that has very low momentum, it's flat, it's not really moving anywhere, you're not going to get a lot of good signals with the Ichimoku Cloud indicator. You're going to get a lot of fake out signals. So fake out signals would be signals that don't match up with all 3 points. So all 3 points would be, if you have a TK crossover to the downside, you want the share price to be beneath that conversion line, and you want the lagging line, where the endpoint is for lagging line, to be beneath the share price 26 periods into the past. Same, it's opposite for TK crossover to the upside. So if you want a good confirmation, not a fake out, you want share prices to be above that TK crossover to the upside, and you want the lagging line endpoint to be above previous 26 period price action. So that's how you avoid fake outs with TK crossovers. On stocks that have very low volume, there's going to be a lot of fake outs. There's going to be a lot of trades that you shouldn't take, and it will tell you that these trades are not worth taking. So you can just avoid them, just ignore them. But another potential weakness this indicator has is that because it's a lagging indicator, it requires data on the chart in order to formulate all the lines. If you're trading with a IPO stock and you're looking at it minute by minute, it's going to be a while. It's going to have to form quite a few candles on the chart before you'll even see the indicator, the rest of the Ichimoku Cloud indicator, get plotted onto your chart. So that's another weakness. It doesn't work very well with IPO stocks or brand new stocks, be it daily time frame on new stocks or short-term intraday time frames on IPO stocks.